Hello, everybody, and welcome to Chapter 6. In this chapter, we're going to talk about variable costing and segment reporting, which is going to branch off from our discussion of CVP analysis, cost volume profit analysis, that we did in Chapter 5. So the first thing we're going to do is talk about the difference between variable and absorption costing. Before we do that, it's important to know there's a few simplifying assumptions that we're going to use in this class. And one is that we use actual costing rather than the normal costing approach that was used in the job order costing chapters. So what that means is we're using the actual fixed overhead costs in our assumptions as opposed to applying overhead based on a predetermined overhead rate. We're also assuming that the actual numbers of units produced is the allocation base for assigning fixed overhead costs. And we know in the real world that isn't always the case. We usually use some type of driver like direct labor hours or machine hours. But that's the simplifying assumption that we use to get across the overall points of the chapter. And then we also always assume that variable manufacturing cost per unit and total manufacturing overhead cost for the period remain constant, which is a common assumption that we make for any type of cost behavior. We always assume that they'll behave the way that they're intended to behave. That is, variable cost per unit stay the same, total fixed cost will also stay the same, whereas variable cost in total change and the fixed cost per unit also changes. So what's the difference between variable and absorption costing? For some reason, through my many years of teaching this course, I found that students struggle with this concept, though they shouldn't, because the only difference between variable and absorption costing is how fixed manufacturing overhead is treated. Under variable costing, only the variable product costs go into the product. That's direct materials, direct labor, and variable overhead. Under absorption costing, which, by the way, is the method of costing you've already been taught, includes all overhead costs, both variable and fixed. So absorption costing absorbs, that's my sucking sound, it absorbs the fixed overhead costs. It sucks it in there like a sponge. Under variable costing, the fixed overhead cost is expensed in the period in which it is used, along with the normal period costs, which are selling and administrative costs. Under absorption costing, only the selling and administrative costs are expensed when they're used because the fixed overhead is absorbed into the product cost. So if you compare the two, the only difference is how we treat fixed overhead. Selling and admin costs, fixed and variable, are always period costs no matter the method we're using. Direct materials, direct labor, and variable overhead are always product costs no matter what method we're using. So again, it's how are we treating that fixed overhead. Fixed overhead is treated as a period cost under variable costing and as a product cost under absorption costing. So given that knowledge, which method do you think would produce the highest values in WIP and finished goods inventories? So take a minute, maybe pause the video and give it a go. And then welcome back. Hopefully you chose absorption costing as the answer. Absorption costing, remember, absorbs fixed overhead cost. So it has more cost in the product. So that's why it's going to have the highest values for WIP and finished goods, because the fixed overhead is going to be included in the product cost, which is part of WIP and finished goods. Under variable costing, that fixed overhead cost gets expensed right away and it wouldn't be included. Therefore, variable costs would have a lower inventory value because it includes fewer costs. So the best way to kind of demonstrate the difference between variable and absorption is to go through an example. So we have Harvey Company, they produce a single product. The number of units produced annually are 25,000, and then we have our variable costs, which are our variable product costs, direct materials, direct labor, and variable overhead of 10, and then we have our variable selling and administrative of 3. Then we have our manufacturing costs that are fixed, our fixed overhead, and then our fixed selling and administrative. So first, we need to calculate product cost. The product cost under variable and absorption costing are both going to include our direct materials, direct labor, and variable overhead. No matter what, those are always included in product costs. The fundamental difference between the methods is how we treat fixed overhead. The fixed overhead's included under absorption, but not under variable. How do we get the fixed overhead per unit? We're going to take our fixed overhead cost and divide it by the units produced. It's important to remember whenever we're trying to get product cost, we divide by units produced. And I know that sounds weird when I say it, but I'm trying to get the point across that a product cost uses units produced, which has the word product like right in it. So product costs always use units produced. So we're going to allocate that fixed overhead cost based on the units produced to get that $6 per unit. So absorption cost absorbs, sucks in that $6 into the product cost, whereas variable cost would not. So now let's compare our income statements under variable and absorption costing. So in order to do this, we need some more assumptions, and we're going to assume that we sold 20,000 units at $30 a pop, and there's no beginning inventory. Now the first thing to note is that whether we use variable or absorption costing, sales will remain the same. There's not going to be any difference. We sold 20,000 units at $30. Variable or absorption costing, it's going to be the same sales. Now, when we're using variable costing, we use the contribution margin format, which you may remember is sales minus variable cost equals CM minus fixed cost equals NOI. So our variable costs come in two main categories. Our variable cost of goods sold, which is our product cost, our variable product cost. And then we have our variable selling and administrative, which is our variable period cost. Now, it's important to know that when we're getting cost of goods sold or selling and administrative costs, we're always multiplying by units sold. Why? Because this is an income statement. An income statement is based on how many units we sell. So that's important to remember. Even though we produce 25,000 units, we're getting our cost of goods sold and selling and administrative costs based on how many units were actually sold. So we sold 20,000 units. The variable manufacturing costs are 10, so we're going to include 200,000 for our variable cost of goods sold, and our variable selling and admin are going to be 20,000 units sold times the $3 per unit variable selling and admin cost, and that gets us 60. Together, our total variable costs then are 260, which allows us to get our CM, which is 340. Under the fixed cost, you can see that we take all of the fixed overhead costs and expense them right away. So it's treated as a period cost. So these are fixed period costs, both the fixed overhead and the fixed selling and administrative. Prior to this chapter, fixed overhead was always a product cost. So that's the fundamental difference when we're dealing with variable costing, is the fixed overhead cost is now treated as a period cost. And then our fixed selling and administrative is also deducted to arrive at our net operating income. Remember, with a contribution margin income statement, we're breaking up our costs by behavior. So variable on the top, fixed on the bottom. Under absorption costing, we're going to have the same sales as I already mentioned, but now our cost of goods sold is going to be the 20,000 units sold times the absorption unit product cost, which includes $6 in fixed overhead per unit. So here we're using a traditional income statement. So we take our sales minus our cost of goods sold, and that gets us gross profit. And then we take out our selling and administrative costs. So we're going to take out our variable selling and admin, which is the 20,000 units sold times the variable cost per unit of 3 for selling and administrative, and then our fixed selling and administrative. So when we're doing absorption costing, we're using a traditional income statement which breaks out cost by category, product at the top versus period at the bottom. And now notice that the fixed overhead cost is included in the product cost. It's part of cost of goods sold. It's not in our period cost. That's the only difference between the two methods. So the difference in our income, you can see, is 120 under absorption versus 90 under variable. So that difference is the result of the fixed overhead getting sucked into inventory under absorption, and then it gets stuck there because we produced more units than we sold. Anytime you want to figure out the difference between variable and absorption costing, here's a simple little formula that you can always use. The difference in NOI for variable and absorption equals the change in inventory times the fixed overhead per unit produced. So we know that the change in inventory, because we produced, if you go back several slides, we produced 25 and then we sold only 20. So the change in inventory would be 5. And then we know our fixed overhead per unit produced was 6, and that's where you get that difference of 30,000. So the only reason there's a difference between variable and absorption income is because of the fixed friggin' overhead. That's it. It's the only reason. Fixed overhead. So how do we get that difference without doing out an income statement for each method? Well, this is the shortcut formula that I recommend that you use. So the difference in NOI between the two methods will always be equal to the change in inventory times the fixed overhead per unit produced. So we already got the fixed overhead divided by the units produced to arrive at the $6. So the $6 represents the fixed overhead per unit. And that gets us our differential, which is 30,000. We'll talk about why absorption is higher than variable income in a little bit. So let's do that reconciliation. So here's a great slide. I think it really shows you how each method differs. So under absorption costing, the fixed overhead cost of 150, that's the total, 120 of it ends up in cost of goods sold. That's the 20,000 units that we sold times the $6 fixed overhead per unit. Whereas 30,000 ends up in ending inventory, which is the 5,000 units left over times $6 a unit. Why are there 5,000 left over? Because again, we produced 25 and sold 20. So there's 5,000 left. So effectively 30,000 in the fixed overhead costs gets stuck in inventory under absorption and therefore isn't expensed. And that's why the income ends up being higher under absorption. Because under variable, the entire 150 is expensed right away. So really the only difference between income is how we treat that fixed manufacturing overhead. So under absorption, whenever we produce more than we sold, which is what happens here, if we produce more than we sell, then our inventory goes up, which means some of the fixed overhead costs get stuck in inventory under absorption and therefore won't be expensed. So when this happens, absorption NOI will always be higher than variable NOI. So whenever production is greater than sales, inventory goes up, which means some of the fixed overhead gets stuck in the inventory and therefore is an asset, not an expense. And then that's why absorption NOI would be greater than variable. We'll see in a little bit that when production is less than sales, the opposite holds true. So the reconciliation of our income is based on that fixed overhead per unit. So our variable net operating income was 90. The 30,000, which is the change in inventory times the fixed overhead per unit that was stuck in inventory under absorption and not expensed is the reason why absorption income is 120. So let's look at year 2. Now we're still producing 25,000, but we're going to sell 30. How the hell can we sell 30 when we produce only 25? Well, because we're going to use the 5,000 that are left over from last period. The unit sales price is still 30. Our direct materials, direct labor, and variable overhead is still 10. The selling admin variable is 3, and the fixed costs are the same as well. So how does this all play out? Well, notice that our unit costs are the same because the variable cost per unit don't change, so the 10 stayed the same. And because we produced 25 again, the fixed overhead per unit stayed the same as well. If we produced a different amount of units, then the fixed overhead per unit would change. So under variable costing, you'll notice that we take units sold times the selling price to get sales. That's going to be the same under either method. The sales number won't change. And our variable cost of goods sold is the units sold times the variable product cost. And then our variable selling and administrative is the units sold times the variable selling and admin per unit. That allows us to get contribution margin. The entire $150,000 in fixed overhead is expensed as a period cost, as are the fixed selling and admin costs, which allow us to get to our NOI of $650. Under absorption, as I went on to the next slide, I noticed an error that's made here in the math that's done by the publisher. So 900 minus 390, I have limited math skills, but I'm pretty sure that is not 900. So this should be 510, and I will fix this before I post it for you. So that should be 510, then minus 250. This should be 260,000. So under variable costing, if we have the math correct, net operating income is 260. Under absorption, it's 230. Now, if I'm being honest, the reason I found the error is when I clicked onto this slide and saw 230, I said, whoa, the difference can't be that big. It can't be 650 versus 230. It has to be only $30,000 different. And the reason is that fixed overhead cost that we talked about. So I'll explain more in a second. Sales, same 900 grand as variable. Cost of goods sold, though, is the units sold times the absorption unit product cost of 16. That allows me to get my gross profit. And then the selling and admin costs are the variable times units sold, and then the fixed piece to arrive at the net operating income. The reason now that we have a difference is the 5,000 units times 6 to get the 30,000 difference. I told you before that the difference in NOI between variable and absorption equals the change in inventory times the fixed overhead per unit produced. Probably can't read that very good, but it's supposed to say PROD for produced. So now what happened? Well, we produced 25, we sold 30, so the change in inventory is now -5. It went down by 5. Now, I'm not going to have you put in negatives or positives. I think that's just going to screw with your mind. Instead, the change is still 5,000 times the 6 fixed overhead per unit gives us the difference in income, which is 30,000. How do I know which is higher? Well, when we produce less than we sell, it means our inventory goes down, which means absorption, NOI, is going to be less than variable NOI. It should make sense. It's the opposite of what happened before. So when we produced more than we sold, inventory went up, which means some of the fixed overhead got stuck in inventory and wasn't expensed, and that made absorption income higher than variable. Now we're producing less than we sell, so inventory is going down, so some of that fixed overhead that was stuck last year is now unstuck in the current period and expensed under absorption. So that results in absorption having a lower income than variable. It's like the good old saying, what goes up must come down. So if you have fixed overhead stuck in inventory at one point, eventually it's going to get unstuck. And that's what's happening here. So the reconciliation between the two would be variable costing income is 260. Then we deduct the fixed overhead that's released now from inventory, which is 30,000 under absorption, and that gets us our absorption net operating income. So when we produce more than we sell, that fixed overhead cost of 30,000, which is the number of units, this is the change in inventory, times that fixed overhead per unit. So when we produce more than we sell, that 30,000 got stuck in inventory and therefore wasn't expensed under absorption. Now the opposite happens. We produce less than we sell, so it got unstuck and gets expensed under absorption, and that's why absorption income is lower. For a better understanding, in year one, you can see absorption is higher by 30,000, whereas in year two, absorption is lower by that 30,000. So all that happens is in the first period, because we made more than we sold, some of the fixed overhead costs got stuck in inventory under absorption and wasn't expensed. That's why absorption income is higher in year one. In year two, when we produce less than we sell, then what happens is that previously stuck fixed overhead cost gets expensed under absorption, lowering its income compared to variable. This only matters when production is different than sales, because as you can see over the course of the 2 years, when production and sales are the same, the total for the 2 years is 350 under each method. So if you don't remember, we produced 25,000 in both years. We sold 20 in the first year, 30 in the second year. So in total, we produced 50 and we sold 50. So whenever production equals sales, absorption and variable income are going to be the same. But that doesn't happen in the real world very often. We usually produce a different amount than we sell. So to summarize what happens to income between the two methods, this slide does it for you. This is how I remember it. Rather than memorizing this slide, I just remember that production comes before sales alphabetically. So production and sales, I write that out alphabetically. And then absorption and variable, NOI, also in alphabetical order. And then if you set it up like that, where you have production and sales in alphabetical order, then absorption NOI and variable NOI in alphabetical order, then you just put your little crocodile in, your greater than or equal sign, and keep it in the same direction. So when production is greater than sales, absorption NOI is greater than variable NOI. Why? Well, we already talked about it, because fixed overhead gets stuck in inventory under absorption and not expensed. So therefore, expenses are lower under absorption, which makes net income higher. We can switch this up. When production is less than sales, absorption income is less than variable, because under absorption, the fixed overhead that was stuck in inventory gets unstuck and expensed, thus increasing expenses under absorption and decreasing the NOI when compared to variable. And then finally, put in an equal sign. When production equals sales, absorption income would equal variable income. I think you see with a little practice, this could be very easy. It's one concept, how we treat fixed overhead, that's different between the methods. That's really it. So why do we go through all this? Well, variable costing categorizes cost as variable and fixed, which then allows us to do that CVP analysis that we talked about in Chapter 5. Because absorption costing assigns fixed overhead costs to its units, a portion of the fixed overhead resides in inventory when the units remain unsold. Remember, we said absorption absorbs like a sponge the fixed overhead, and then the fixed overhead gets stuck in inventory until it's sold. The potential result is positive operating income when the number of units sold is less than the break-even point. So, in other words, if we don't use variable costing, CVP analysis won't work. That's the bottom line. Variable costing is only affected by changes in unit sales, which seems to make sense, right? If I sell more, I should make more money. If I sell less, I should make less money. So that's how variable costing works. But absorption costing is influenced by changes in unit sales and how many we make. Basically, if I want to increase income, I can make a bunch of units at the end of the year. And then what happens is the fixed overhead under absorption gets stuck in inventory when I produce more than I sell. So the more I produce, the more fixed overhead I can get stuck in inventory, and therefore manipulate my income and make it higher. So as inventory levels go up, absorption sucks in more fixed overhead costs into the ending inventory, therefore providing a lower expense and a higher income. So basically, absorption costing allows management to manipulate income simply by producing more or less units at the end of the period, which isn't necessarily meaning the company is actually doing better or worse. So variable income is a better indicator of how well the company is performing. The last little concept that you want to keep in mind is variable costing correctly identifies the additional variable cost to make one more unit, which is $10, right? The direct materials, direct labor, and variable overhead. Because absorption assigns fixed overhead costs on a per unit basis, you're adding another $6 to get the unit cost under absorption of 10 plus 6 or 16. So then managers make inappropriate decisions thinking that to make one more unit, it really costs $16 additional, when in fact that isn't true. The fixed cost isn't going to change in total. So to make one more unit, it'll only cost 10. But because we're under absorption, including fixed overhead and the product costs, managers might think, oh, it's going to cost 16 to make one more unit. So if somebody comes along and says, hey, I'd like an extra 1,000 units, can you cut me a deal? How about you sell them to me for $15? Management's going to say, oh, no, we can't do that. It costs us $16 to make it, when in fact that's bullshit and it only costs 10. So you can make inappropriate decisions by using absorption costing. So why the hell do we use absorption costing? Well, GAAP requires us to do so, which is why we taught you to include all overhead and product costs in earlier chapters. Why does GAAP require it? Well, because GAP's philosophy is that you can't make a product without a factory, without production supervisors, etc., without all those fixed overhead costs. So we should include those costs in our product. So GAAP has to make cost-benefit analyses and saying that, well, if we don't include those costs in the product, it gives us an underestimated amount for how much it really costs to make a product. So they're saying that that's more important than the fact that management can manipulate the numbers or make inappropriate decisions. And that makes sense because GAP's focus is on the external decision maker, not the internal. So as an internal decision maker, we have to say, absorption costing isn't so great. I'm going to have to do variable costing if I want to make really good decisions. And that's why most companies that want to make good decisions are going to end up using both types of costing, both variable and absorption. Variable for internal decision making and absorption for external reporting.